Can I zoom in on this? There we go. Look at that. Right here. All right. This light's too bright. Way too bright.
You can turn it off or just spin it?
I don't know if it is.
Okay.
Yeah, it's horrible. Moving that one is, you need to turn that. Yeah, turn that light over there. There you go. Perfect. Yep. Okay. Okay. Hey everybody, and welcome. Jerome Maldonado here, and we are live on Facebook. No, we're live on YouTube and Facebook. We're live on YouTube and Facebook and Instagram. We're live on everything. So, ladies and gentlemen, welcome to Real Talk on Real Estate. It is Wednesday afternoon, and we have a great topic today. I mean, hands down, we have an incredible topic today. This is one that I love. It makes me feel warm and fuzzy because with this topic that we're talking about today, it's the top 5 tax advantages of real estate. And so one of the big things is that people realize that you can get involved in real estate and you can generate residual income through rental properties and passive income through leasing properties. You can also have a cash-on-cash return on real estate, which means that your property appreciates, you sell it for a profit, and you make money. But one of the things that most people do not realize, one of the big benefits of real estate that people do not realize about real estate is the fact that the great tax benefits that come with it. And so this is one topic that I want to talk about today is the tax benefits that come along with real estate. So we're going to be talking about the top 5 tax advantages of real estate today on Real Talk on Real Estate. And I'm going to share with you guys the 5 most beneficial ones. Okay, so there's 5 of them. You're going to want to take note of these. Number 1 is deductions. Okay, so your tax deductions. It's one of the most basic tax advantages to investing in real estate. And it gives you the ability to deduct certain expenses. Okay, so anything that you have related to that property, you have the capability of deducting. So for example, let's say you have property taxes. You can deduct your property taxes off your income. You can also deduct property insurance. So if you're paying for insurance, liability insurance, you can deduct that. Mortgage interest. Okay, you can deduct your mortgage interest. So if you have a 4% interest rate on your mortgage, a 5% interest rate, all of the interest that you pay each year to service the debt on that property, you get to write off entirely. You get to also do property management fees. So like any of the management fees that you have running the property. So if you're self-managing, any expenses that you incur personally managing that property, like driving down to the property, any paperwork, stuff from Staples, Office Depot, whatever it is, you got to write that off. If you hire a third-party manager or third-party management company, any fees that are associated with them managing that property, meaning that any fees that they charge you, you get to write off 100% of that stuff. And so deductions go on and on. You can do property repairs, capital improvements being any expense that you are putting into the building to maintain it. So parking lots, if you have to stripe it, blacktop, if you put in a new roof on the property, if you're putting a new stucco exterior facade, if you need some handrail repairs, if you're putting new heating and cooling systems in the property, those are all capital improvements. Those are all things that improve the asset. If you're redoing landscaping, irrigation, you're doing planting, flooring, concrete work, whatever it is, those are all capital improvements. So hence, you can deduct any capital improvement expenses, property repairs, or anything that you utilize to make that property either better, so any value improvements, any value adds, or any type of property repairs and ongoing maintenance. So if you have a person there that's maintaining little things like light fixtures, water fixtures, sprinklers, landscaping, parking lots, scraping snow, like a day like today out here, we have snow. You scrape the parking lots, all that stuff is a tax deduction. So that's one of the first benefits of owning real estate is the tax deductions. And the number 1 of the top 5 is physical deductions. So like advertising expenses, the costs to list and rent the property, those are all expenses that you can write off. Many real estate investors choose to own their investments in real estate with an entity And when you do that with an entity, there's even additional tax benefits towards owning that property under an entity. So for example, so if you own it under an LLC and you have it under a separate entity other than your name, you have a commercial piece of real estate, residential piece of real estate, you can, the advertising expenses such as mailers, off-market leads, business cards, signs for the office, signs for the property, all that is tax deductible. If you incur legal or professional fees such as accountants, attorneys, bookkeepers, all of that stuff is also tax deductible. Any business equipment such as laptops, the laptop that I'm doing this on today, my work phones, all of that stuff, our office desktop, everything is a tax deduction when you own it under an LLC, because anything that you're utilizing to facilitate business, whether it's a phone call to one of the brokers or the property management company, or if you're doing a live Zoom call on your laptop, all of that stuff becomes for business use for that property. So if you have it under an entity, that now becomes a business. And when you have business expenses, anything that you utilize to facilitate business becomes a tax deduction, which brings down your tax rate, right? So for some of you guys that are working full-time, I have a ton of people that work with us that are students and active investors that do not want to quit their full-time job because they either love what they do or they have a really good income. They've utilized the means of real estate to supplement their income and build their long-term wealth and being able to generate assets that they own, right? So let's say, for example, you're generating $150,000 a year in payroll income. Okay, now you're sitting at one of the highest tax brackets. You're over 30% on your federal tax returns. So where you would normally get paid taxed at 30% or 30% plus on your federal income taxes, now you have a business, you can deduct all your expenses. So let's say, for example, you have $20,000, $30,000 of business expenses. Now you can offset your taxes that you're paying, even from your company, to be able to offset your overall taxes, especially if it's an LLC, because an LLC is a pass-through entity, which means that all the income that comes in from that business just gets passed through to your personal income taxes. And so you take the deductions from the LLC and it decreases the amount that you actually are taxed on at the end of the year, even through your employer. So you either get a tax refund or you pay less taxes, depending on how you have your tax structure. Okay, now.
We lost power.
No, on that one right there, that one went down.
Okay.
So we lost a
We're
little bit of power here, but we're good here.
We got battery?
We might have, yeah. Okay. Okay, so office expenses, communications such as internet, PO boxes, phone lines, business lines, electric, gas, all that stuff becomes business expenses. Did we lose power on that one? That one's good. It's going good. Okay. So we got Daniel here in the background facilitating some business. We're getting ready to head out to Washington State next week. We've got a big project that Raymond and I are working on, so we're excited to bring that to you guys. We're going to be implementing a lot of these same tax strategies that I'm talking about here with this one, and we implement these every single day. And so our flight out there is tax deduction because it's a business expense, right? The food that we eat is going to be a tax deduction. We go out to eat, we take people out to eat, we take investors, entertain them. We go ourselves, and we're facilitating business communication regarding the properties, the projects, all tax write-off. And so all that stuff is beneficial. Your travel expenses, vehicle mileage, your parking fees, anything that you pay for education. So any of you guys who are part of our educational program, it's all tax deductible. The membership, such as annual fees, trade associations, costs for seminars, books, courses, any of that stuff is a tax deduction if you have a business and you have one piece of real estate under an entity. Your mills, all of that stuff becomes a tax deduction. So mills, you can only write off up to 50% of everything that you eat on your mills, but you can, and then you can also write off $5 per square foot on your home office if you're doing business in your home, and at a maximum of 300 square feet. But what's cool is you can keep records of all that. If you keep good records, you can write off all those expenses and even doing business in your home. So even though I have an office here, because I still facilitate business out of my house, I still maximize that 300 square feet of business area. So I deduct that piece off my house every year as well. So hence we're able to decrease our taxable income, even based off of just one property. Second, of the 5 top tax advantages in real estate is depreciation. This is my favorite because this is where I actually get the largest tax savings is off of depreciation of assets. And so on rental properties, year after year, you can deduct them. On residential, you can deduct for 27 years. On commercial properties, you can take depreciation for up to 39 years, or you can take accelerated depreciations on the property, and you can take advantage of larger tax deductions in a shorter amount of time. Now, I'm not an accountant. I don't claim to be. I'm going to give you guys information that we exercise and utilize through the advice of our professionals, our attorneys, and our accountants. Now, my recommendation to you is to advise with your accountants and your CPAs and your attorneys to make sure that you're structuring this stuff correctly. But I want to be able to give you guys that information so that it's at your fingertips and you guys have that available to be able to go back and take advantage of on any property that you own. So if you're buying single-family rental homes and you're flipping them, understand that you can take depreciation on that property for over 27 years. So if you, let's say, for example, you pay $200,000 for a property, you can deduct the annual depreciation at about $7,200 a year and not pay taxes on $7,200 per year each year for 27 and a half years on that $200,000 purchase. Or if it's a commercial property, you can do the same thing and you can divide it up over the course of 39 years. Now, with that being said, what we do often is instead of going in and depreciating assets over the course of 27 years or 39 years, we take an accelerated depreciation because our tax liability is so high each year because of our businesses, our income, and everything else. What we typically will do is we'll buy an asset towards the end of the year and we'll depreciate that asset and take an accelerated depreciation where maybe we take all of the depreciation in a 5-year period as opposed to 39 years. Hence, we're able to save money on our taxes year after year, and we continue to buy. So as long as we're in the business and we're continuing to buy, we get to take advantage of those tax savings. Now, with that being said, understand that once you sell that asset, it's not tax deferred, it's tax free until you capture the gains. So what I mean by that is if you have a $200,000 property that appreciates to $300,000, but you depreciate it down to maybe $100,000, when you sell it for $300,000, you have a $200,000 capital gains on your taxes. And you have to recapture those when you sell. That's why a lot of our holdings, we keep them. So like the building, our office that we're in, we've had this building for over almost 22 years now. And so we've just continued to depreciate the asset. We hold it. This property has made us over $2 million in rental income. It's just a small 8,000 square foot building that I bought back in 2000. And the rental income has made us well over $2 million in gross rental income. And so instead of going out and selling the asset for $600,000 when we pay $250,000 or $750,000 or whatever it is, we just keep the asset. And so if we don't ever sell, we don't have to recapture those gains. We just have the taxes on our cash flow on all of our rental income. So depreciation can only be used on investment properties, making it a huge tax advantage for people to take advantage of real estate as an investor. So for those of you guys who are looking to be able to save on taxes and you're looking for ways to shelter money, real estate is not only a great way to create independent wealth, residual income, and long-term asset holdings, but it's a great way to have a tax shelter as well. And so I talk about this stuff because it's important for people to understand. And so when you go in, you recapture like some of the gains, you're still not even taxed the same rate as your ordinary income. So if you go back in and let's say you're that person making $150,000 to $200,000 a year, you depreciated an asset down to $100,000, and then it appreciates back up to $300,000, and you have that $200,000 in gains. You take the depreciation at your current income tax bracket. So let's say you're at 31% for income tax for federal income taxes. Well, when you recapture those gains, you're at a maximum rate of 25%. So even if you have gains and you depreciate them, you're still at a gross net of 6% on the taxes just by doing that. So you still save 6% per year on whatever you're deducting. And so when you look at like cash on cash return, there's a good investment. It will seep you 6 to 8% a year. So if you even just benefit from that 6% for sake of example, and you do buy, hold, and sell, you want to put yourself in a position will you take advantage of those tax benefits? Okay. Let's see. Edward Garcia asking a question here. I have a single family home as an investment and selling it, never claimed depreciation for 10 years. What can I do? So if you never took depreciation on it, you didn't take the tax benefits of it initially. If you're selling it, now you just have to pay your gains. You can't depreciate it anymore, but you don't have to recapture those gains. So exactly like I was talking about, even if you would have depreciated the asset over the course of the 10 years that you owned it, and let's say you were at a higher tax bracket than the 25%, like we are, we're at the highest tax bracket. So even when we depreciate, when we recapture those gains, the maximum that they can tax us on is 25%, right? So I still have a positive write-off when I land up selling and capturing those gains. The good thing for you is you haven't depreciated anything. So if you sell it for a loss, you can take the loss at that time. But if you're selling it for a gain, then you'll have your capital gains taxes. And so you'll be at a maximum of 25% income taxes. Do not tax it as ordinary income. Make sure you tax it. And I'm going to talk about that here in a second, Edward. I'm kind of getting to that one here in just a second when we talk about tax deferred. Abilities with real estate. So, okay. So number 3 is going to be passive income and pass-through deductions. Okay. Now I like this because all of you guys who have come in, you follow our content, you're one of our students. Everything that I talk about is multi-unit real estate. Everything that I talk about is being able to cash flow multiple ways. You know, I look at my stocks in the stock market the exact same way. I sit back and say, okay, how do I generate multiple streams of income with everything that I do in life? And so with real estate, you sit back and go, okay, I can get cash on cash returns if I have a rental property that I have tenants in and I stabilize that property with rental income every month. So you have income coming in, you have residual income. And that's what number 3, passive income and pass-through deductions comes into play. Or you get your cash on cash return. I mean, you get your, if you give your cash on cash return, then you have your internal rate of return. That's the return that you get when you sell the property. So it's the gains that you get when you sell the property that actually you benefit from on your not on your cash on cash returns, but on your internal rate of returns. Okay, so you get to be able to save. You get to be able to generate on cash rental income, internal rate of return, whatever it appreciates to, and you sell it for its appreciated value, and then all the tax benefits that you have, which I'm going over the top 5 right now, and there's more of them. And so when you go in and you have passive income in real estate, it's cash flow that is earned without having to go out and work for it, right? It's passive income. It's often confused with it's a passive income, and it's often confused with a passive activity, you know, so you don't have to go out and be active to earn that income. It's the building actually generates the income on your behalf because people are renting space out of it. And that's how you get an asset to have your money and your assets working on your behalf. Okay. According to the Internal Revenue Service, passive income is any money that is earned from rental activity or business activity in which they don't materially participate in, yet you are able to benefit from its existence, right? So it's not income that you go out and you punch a time clock and work by the hour. It's income that comes in passively through rental income. Okay, so that's how the IRS distinguishes the difference between income from income taxes that you're working for your paycheck. For some of those you guys are watching this sitting at work, that you're getting taxed on your 941 taxes and your 940 taxes. This is different. This is income that comes in passively. And so the way the IRS looks at it is it's taxed at a different rate than your actual working income. And so you can deduct any expenses that you have associated with generating that income, going to the property and doing anything that you're doing, facilitating with it. And what's cool is that before 2018, the only way to offset passive income was with passive losses on the property. But when they put together the Tax Cut and Jobs Act, when it was passed in 2018, it allowed businesses who qualified for this and generated income to be able to get pass-through income taxed at 20%. So maximum of 20%, which is awesome, because if you're in a 35% tax bracket, a 30% tax bracket, if you go in and you generate income from rental properties, let's say your rental income increases larger than what you make working a job. Okay. Now working a job, you're going to get taxed at the highest tax bracket. Like with my company, when my business pays me a paycheck that I own, because I draw a paycheck for my company, because that's what you have to do as a corporation. I get taxed at the highest tax bracket that there is because of the revenue that we generate and because of all our pass-through entities. But what's really cool is that we have tons and tons of LLCs, and every single one of those LLCs has passive income. So instead of getting taxed at the highest tax bracket, I'm able to take advantage of the 2018 Tax Cut and Jobs Act that was passed. And this is good all the way through 2025. So we still have another 4 active years of this, and hopefully it gets extended because this is a great tax benefit. I get to be able to take I get to take a lower tax rate on that, all of that income that comes in of only 20% maximum. Maximum amount that I'll get taxed on that is 20% on my pass-through deductions, which is great. Now, it's important to understand that you can only take advantage of these pass-through deductions in your business if your business is profitable, and not all income types qualify for it. Only income like we're talking about through rental properties qualify for stuff like this. So you want to make sure that you consult with your CPA, your accountant, bring this stuff up to them and ask them about this stuff. And this is what this information is for. It's not to say, hey, well, Jerome said, but you can say, hey, look, I heard this on YouTube Live. I understand from one of the real estate professionals that I listened to that there's some tax benefits on passive income. I don't want to get taxed, because if your accountant doesn't know all of the Tax Cuts and Job Acts of 2018, which there's a lot of them, don't take for granted just because you have an accountant or a CPA that they keep up on everything, because they don't. And so it's your job as an investor to know this stuff or learn this stuff to take advantage of it so you can benefit from it from your taxes. Because I sit down with my CPAs every year, and I sit down and we start reviewing entities as they finish them, right? And then we look through it. And then I sit back and I have the oh shit factor at the end of the year. I'm like, when I land up going in, I'll cut a check now on April 15th, a big one, thinking, okay, that should cover almost everything, right, that I need to pay. Then we file extensions. And then when we get to September and October, when we have our extensions for our personal and corporate taxes, we tally all this stuff up, and we're looking through all of our tax write-offs. And so it's my job to stay affluent on some of these new updates that are going through legislation each and every year to make sure that we're taking advantage of these. And I don't take for granted that they remember them or they take advantage of them, because there's very few people in the world that are doing what I'm doing in regards to real estate growth. And there's going to be very few people in the big scheme of things, right? So when you're in this world, you feel like everybody's invested in real estate. But the reality is there's very few people in percentage to the whole world. So when you talk to a CPA or that if they're not a specific real estate tax CPA, then you want to make sure that you're getting your deductions. So I'll sit back and I'll question and say, hey, did we take a deduction like this? How do we capture the income from the properties this year? Did we take advantage of the 2018 Tax Cut and Jobs Act? And do we only maximize my taxes at 20% versus whatever my federal tax bracket is that year, right? And so you want to make sure that you're educated in this stuff so you can educate them so that you save on your taxes. That's the benefit of owning real estate, having passive income through real estate, so forth and so on. So number 4, capital gains taxes instead of income taxes. Okay, so we'll talk about that here in a second. Let's see, let me go ahead and take a question. Mr. John Oliver, welcome and thank you for watching. After acquiring a commercial property, what does it normally cost, ballpark, to have a cost segregation study done so that you can claim bonus depreciation on your property in the first year? So look, the cost on it, John, is the cost of whatever your accountant is gonna charge you. Now, see, they don't talk about cost segregation aggressively, but we use cost segregation every single year, and there is expense to it, obviously, to be able to deduct your properties, but we use cost segregation almost every single year to depreciate our income. And that's the beauty of real estate, is that I'll go in and buy a piece of real estate each year, and I'll say, okay, how much did we earn, and how much should I take in accelerated taxes? Because that's basically what cost segregation is in doing cost segregation studies. You take an asset And instead of depreciating like a commercial asset over 39 years, like we were talking about earlier, you're able to accelerate the taxes and take that depreciation in a condensed amount of time, whether it's 1 year, 2 years, 5 years. And you have to get with your CPA so they can help assist you in that regard and make sure that you're following the tax laws in regards to and the cost segregation requirements to be able to take advantage of those. But we do that every single year. We buy a property and you get with your CPA. So typically your CPA will work out the cost with you and for you, and they'll help assist you, because a lot of good real estate CPAs or real estate attorneys, a lot of times if I don't have a CPA that can help me on any particular property, if it gets too big or they don't understand all the laws, I'll get with a tax attorney. I'll get with a tax attorney that specializes in real estate to help us. And so typically I have them partner up. And in all honesty, I don't know if it's typically my attorneys or my CPA that actually gets the tax deductions and the cost segregation studies completed for us each year, but it's through a collaborative effort between our attorneys and our accountants. And so I'll tell you guys, people are sitting here, they're watching this stuff and they'll say, well, I don't want to hire a CPA or I don't want to hire an attorney. Understand that with good help, you're going to save. So if you go in and you buy an asset that's $1 million, and let's say, for example, you generated $300,000 or more in revenue. So I have a business partner, I'm doing business with him in Washington State. He generates about $300,000 a year in income working for Microsoft, but then makes about another $300,000 or $400,000 a year just building out 1 or 2 homes every year. Now we're scaling it. So he's going in making $600,000 to $700,000 a year. So the project that we're doing for next year, we go in, we do a cost segregation study, we accelerate the depreciation. He could take that depreciation in 1 year from our new project and then offset those income taxes and be able to reduce his tax liability. And then we're able to go in and then facilitate business on this project. And what's great is that 1/3 of everything that we're building out, we're keeping for long-term holdings, so that way we're building a portfolio in the interim time of also turning, developing, and generating revenue as a business at the exact same time that we're actually purchasing the assets. So like I talked about earlier, he doesn't have to claim that income anymore as ordinary income. He can go in and and do it as passive income. And through the passive income and pass-through deductions, now he's maximized at 20%, which normally he'd be at the highest federal tax bracket. Now he maximizes his taxes later when we recapture those at 20%. So really cool stuff. John, I hope that helps you. If you have additional questions, throw it back out.
That's John from Recruit.
Oh, cool, John. Good to see you here, man. Okay, so capital gains taxes instead of income taxes. One of the things, John actually is working with us in our internal circle and working with us on our real estate development program and stuff. And he's always real active with questions and stuff. So I always appreciate that. Capital gains taxes. That's how you learn, ladies and gentlemen, is by not being bashful, by being assertive and getting yourself out there, getting your questions answered, getting yourself in the game and moving forward. That's how you make big moves in this industry. And that's how you make big moves in anything in life. That's what I tell my children. I say, look, guys, you guys can't just sit on the sidelines and expect to win. You got to get involved in everything that you do. And if you're sitting on the sidelines expecting to win, I've never seen somebody in the stands win a Super Bowl. I've seen them cheer and paint their face and act crazy, but I've never seen them walk away with a Lombardi trophy, right? So you want to walk away with a Lombardi trophy in the real estate game being profits in your bank account. You need to join the game. You need to be a part of the game. You need to be assertive in the game. And if you're not assertive and you're sitting back going, hey, this is not my demeanor, I'm just not an assertive person, that's up to you. Whether you're assertive or not assertive is your decision, because people don't know that. It's an active decision. Look, I don't go out after hours and claim to be this outgoing, rambunctious person. But when I come here and I'm sitting here giving to you guys and we're doing our real estate stuff, our business stuff, I'm assertive, I'm in the game, I'm pushing, and I'm doing whatever I need to do. So that later on, when I go home, I can be Jerome and I can just be dad. I can be a husband. I can be, I can just be who I am without having to be flamboyant and outgoing and overdone, right? So I leave that for the office. I go home and I relax. So you want questions, you have questions, you want to be a part of this game. Don't hesitate to shoot out questions. We have answers. And if we don't have answers, we'll find you answers. And that's the name of the game. So number 4 here, capital gains taxes instead of income taxes. So I kind of hit on this a little bit already. And so what capital gains tax are is when you sell a property for more than you originally purchased it for, the profits will be taxed as short-term or long-term capital gains, okay? So typically, capital gains taxes are lower than your ordinary income taxes, and that's the benefit of capital gains taxes. So even if you have to pay them, typically they're less expensive than ordinary income taxes. And so when you sell it, like short-term capital gains is when you sell a property that you've held for 1 year or less. And so you have short-term capital gains. They can range anywhere from 10% to 37%, okay, on your short-term capital gains, depending on your income bracket. And so on short-term capital gains, there's not a huge benefit. You'll get a little tax break. You really benefit from your long-term capital gains, depending on your income bracket. Long-term capital gains, which are properties that are held for a year, for 1 year or more. You get better deductions if you hold it for over 2 years. And especially on single family homes, personal residences, each spouse can take up to $250,000 in gains. So right now, when the market is just ridiculous in a bubble and people are selling their properties for immense profits, you can, if you're in a prime market and your house appreciates $500,000 and you're married, you can take that. You can offset your capital. You don't offset. You don't have to pay taxes on $500,000. It's tax free if you had your house for over 2 years and you're married. And your spouse and yourself each takes a $250,000 tax write-off. Okay, but on long-term capital gains on properties that are held a year and 1 day or more, so you have to have it at least 1 year and 1 day or more to have the taxes become significantly more favorable. And it ranges from having to pay zero taxes, like I just talked about, if you're married and it's your single family residence, up to 20%. So if you do a long-term capital gains holding, you'll never be taxed in excess of 20% on any property that you own for over 1 year and 1 day, depending on your tax bracket, depending on the circumstances of those gains. Okay, again, I consult. Each property is specific. That's why there's a range depending on how and when you sell and how long you have had ownership of it will depict what you're going to be paying. But at maximum, 20%, depending on your tax bracket for anything that's shown over one year and 1 day, which is incredible. Still better than what I pay in federal income taxes. So still a great benefit. You can utilize certain tax-deferred or tax-free methods to invest in real estate to avoid paying capital gains taxes, and some of these methods are number 5. They're actually the investment. The number 5 is to invest tax deferred or tax free. Okay, and so I got some notes here, so I want to make sure I'm covering everything. Yeah, so number 5 is invest tax deferred or tax free. Okay, and so 1031 exchange, like we just talked about, is one of those ways that you can invest tax deferred or tax free. The IRS code, the 1031 exchange, is a legal transaction that allows real estate investors to swap an investment property for a like property. So a property that's similar or of more value, to be able to avoid capital gains or depreciate, or being able to recapture depreciations like we talked about a few minutes ago. And so both are beneficial, and you can take advantage of them through 1031 exchanges. Another way is tax-free or tax-deferred retirement accounts. So for those of you guys who are working a job, you have an IRA or you have a 401k, and you're sitting back, or a self-directed IRA. You guys have the opportunity to be able to draw on that stuff, but not draw on it and spend it. You can keep it in an IRA or a SEP account or a solo 401k, and you can invest that capital. It doesn't have to stay in an actual stock. You can take it and invest in real estate. Now, you can't take it. If you take it and you move the money out of your account, then it becomes taxable based on your gains. But if you have an account like a health savings account, an HSA account, or a special individual retirement account like an IRA, like a solo 401k, an SEP account, an IRA, a regular IRA account, or a SEP IRA, or a self-directed IRA, that the acts will allow you to invest in alternative assets, and real estate being one of those alternative assets, tax-free or tax-deferred. Now, there are annual contribution limits. They vary depending on the type of accounts that you have open and what you're doing. You want to talk to your financial advisor, your tax attorneys, your CPAs to make sure that you do this correctly, right? So I'm not an investment. An investment guy like a Merrill Lynch or an AG Edwards or an Ameritrade person. You want to be able to talk to your financial advisor to make sure that you're moving this stuff over correctly. Now, I've done this multiple times where I sit down with a good friend of mine. His name is Dave. He does a lot of my stock and my stock investments and stuff. I don't have a ton of them. I have maybe about 1/10 of my income. Not even that, probably less than that. Less than 1/10 of our income in stocks, but we still have, a couple $1 million in the stock market that we hold. And one of the cool things is that Dave manages that stuff. But if I ever need that money for like real estate, we're able to take loans on it, or we're able to, if I pull any of that out and I invest it in something else, I don't have to pay the taxes on the gains, especially on a year like this year, where we've seen a lot of stock gains. So I'm sitting back going, okay, what do I do with these gains? Because if the stock market crashes, I don't want my income to plummet. So can I draw on some of that stuff, sell off some of the bad hitters, and be able to utilize that holding it, because I hold some of them in IRAs. Can I use that money and now defer it into a tax investment? I mean, a real estate investment, and take advantage of the tax benefits, and then now take it and scale it even greater, scale it even more. And I keep those as like a little insurance policy. So that way, if I'm maximizing my capital, or we're having problems raising capital from investors or something, and I have just a project that I need to fund because I love it, I can be able to draw on those. And then I can go in and invest in an asset, and either my interest rate from borrowing from my own stock accounts is really reasonable, or I can just remove it from there and invest it. As long as I have Dave help me and assist me with it as my financial advisor, then I can invest in real estate, and I can offset those capital gains taxes completely and be completely tax deferred or tax free, depending on how I structure the deal, right? So really cool. You want to be able to exercise some of those abilities. If you have IRAs, 401ks, SEP IRAs, self-directed or solo 401ks, these are all great opportunities for you to utilize that capital without losing it or using it, right? And usually what I say is, if you're using it, you're losing it. Because if you use it for buying a car or buying a worthless asset that's not producing income for you, you lose it. And so you want to be able to take it and use it, not lose it, use it to enhance and build your real estate portfolio. So number 5, for those of you guys just joined us, we're talking about the fifth tax advantage of owning real estate. Number 5 is investing tax deferred or tax free. Another option you can do, in addition to 1031 exchanges, tax free or tax deferred retirement accounts, is opportunity zones. This is huge, guys. Now, the tax opportunity zones, they're evolving. They're still changing the tax laws. I was real amped up and excited about opportunity zones when it first came out, based on the original laws. And every year, legislation's changing them just a little bit over the last couple of years since opportunity zones came into fruition. But it's great because there's over 8,700 designated census tracts, making up some of the most rural areas in cities, and or just outside of city corridors, or in redevelopment in distressed assets like downtown. In a lot of city and municipalities, there's a lot of opportunity zones because they're financially distressed. There's a lot of old real estate that's beat up, and they want investors, they want developers, people like you guys, people like me, people like all of us that are on here, to go in, buy these assets that are distressed, and then they'll give you reason to buy them, and they'll help you out tax-wise. So you can go in, and depending on how long you hold that asset, you can pay, you could pay no capital gains tax if you sell it. If you hold it for like 10 years or longer, then you're subjected to 0 ordinary income taxes and 0 capital gains taxes. But things are changing. The tax laws and tax cuts are changing. This was another thing that was implemented in 2018 as part of the Tax Cuts and Jobs Act, which allows investors to roll qualified capital gains into an opportunity zone in funds that are in real estate to offset and defer those capital gains taxes as we're talking about. Okay. Let's see here. Another great way to invest tax deferred or tax free is through real estate tax advantages in action, right? So to really show you like how the benefits work, like as they're really working, so the real real estate tax advantages show you how they work in action. Is just by giving you a simple theoretical example. So I kind of wrote some numbers down, just theoretically speaking. This is just to kind of give you a visual perspective of how you can take advantage of this stuff. And so let's say, for example, you purchase a rental property for $150,000. Okay, you put 15%. Let's say let's call it 20%. You put 20% down, which is $30,000 down payment on a $150,000 property. Okay. The annual rental income on that place, let's call it $16,000 and it has, let's say, okay, so what we did, $150,000 purchase, 20% down, which is $30,000 down. You have an annual rental income of $16,000. That's your gross operating income, the gross amount of income that is brought in from that property every single year. Okay. Now, you have $13,000 of expenses, all the expenses that I was talking about, as far as insurance, property taxes, any expenses, capital improvements, office expenses, everything that we talked about as far as tax deductions. You're writing off $13,000 of that $16,000 in property expenses, right? So immediately $13,000 is expunged right off your tax returns. So you still have a $3,000 that's a net taxable amount of $3,000. But wait, okay, So you have you're not going to pay taxes on that $3,000 with the depreciation and with the depreciation deductions. You're able to deduct an additional $5,454, producing a net loss of almost $2,500. So now you have a loss on the property, and not only do you not have to pay taxes on the $3,000, you have a loss on the property of close to $2,500. Essentially, you get to earn $3,000 a year in passive income tax-free, and then you have additional passive income that you have in a net loss that you can still take off. You can still take that loss down the road, okay? And you can offset other income. You don't have to take it down the road. You can just offset other income. So, for example, those of you guys who are working jobs, or you have other businesses, or you have other properties, and those ones did have cash flow, and those ones did appreciate, or those ones do have income on them, you can come in and you can offset the losses, the deduction here, to offset the gains from one of your other investments. And we'll do that each year. Sometimes I'll have Dave, my financial guy, call me up and he'll say, "Hey, Jerome," at the end of every year, and I love this about Dave. He goes, "Jerome, do you have any capital gains tax you need to offset?" And every year the answer is, "Yes, I do." And he said, "Hey, you have ExxonMobil, or you have Pfizer, whatever it is that year that we own." He said, he'll look at the entire portfolio, and if they're winning, he just keeps them. But he said, "This guy is not producing the way I'd like to see it. Why don't we just sell it? We can always repurchase it in a week or two, and maybe even repurchase it at a lower price. But why don't we just take the loss right now and just sell it? And then you can write off the losses against your capital gains taxes to offset your capital gains tax liability," which is great, so that's a great thing. Tracy, how do you learn about opportunity zones? So there's a lot of information on opportunity zones. You can do some self-research on opportunity zones. Legislation every year passes different laws are changing each year. So the legislative session just ended this year. There's some of them that pushed into an extended session. So you can go in and it's all public knowledge. You go into the municipality and and read up on the legislative session and the rules, laws, and regulations for each state. And then you can go into the federal legislative session to learn about some of what the current laws and changes are. And then you can just talk to your CPA and accountant. I would talk to somebody who specializes in some of these tax-deferred opportunities, and people that really understand the 2018 that understand the 2018 tax laws and stuff that were implemented. Because if you can go in and take advantage of the 2018 Tax Cut and Jobs Act, a good CPA should know all about that stuff. You should be able to go in and take advantage of getting wisdom from those guys. And all that stuff's on the IRS website, by the way. You can find out about it, and then you can talk to them. You can even call somebody from the IRS if you're willing to put up with the long wait times. But you can do a lot of self-research on opportunity zones. Now, opportunity zones, you can Google whatever area you're looking to invest in. Just put opportunity zones in Arizona, opportunity zones in North Carolina, opportunity zones, and put designated maps of opportunity zones in whatever municipality, whatever area that you want to invest in. And what's real cool is a map will come up and it'll show it highlighted, the areas that it's in. And so anytime that we're investing in real estate, we go in and we say, okay, like Puerto Rico, for example, almost all of Puerto Rico is an opportunity zone. And then so one of the investors goes, so is this in an opportunity zone? And the only place that we're investing in right now in Puerto Rico is one of the only places that is not in an opportunity zone. But the tax benefits in general are so substantially greater than taking advantage of even the opportunity zones that Puerto Rico is a great place for business owners and affluent people to be living and housing their business because of the federal income tax benefits and state income tax benefits. So forget Texas, Florida, Nevada, and all these tax-free states. I mean, those states are great. I love them, nothing about them. But the federal income taxes, you're getting taxed like 4%, give or take. And so great opportunity. But the opportunity zones, we looked at them, we mapped them when we were over there last week. When this investor asked about it, he goes, so are we in an opportunity zone? Can we take advantage of the tax benefits of being in an opportunity zone? And we said, so we pulled it up, and lo and behold, almost all of Puerto Rico is in an opportunity zone, except for this one little section that we're invested in. Is because it's the real affluent section of Puerto Rico. So obviously it doesn't need redevelopment. We're just able to take advantage of the tax benefits. So, John, the property I'm looking at is literally a few hundred feet outside of the opportunity zone on the opportunity zone address lookup map. Is there a way to get it accepted into the opportunity zone? So those were federally designated. People have asked that before. We haven't found a way to make those changes because it's still so new, John. There's still a lot of information coming out, and they're still fine-tuning all the laws and bylaws with opportunity zones. I would say, I wouldn't tell you no, but I will tell you that it's challenging to get that type of stuff done still at this time, because opportunity zones are only just a couple years. They're a couple years new right now. And since it's such a new thing, being able to go in and expand opportunity zones are a little harder to do. But what you can do is, if it's near an opportunity zone, go talk to the state that you're looking at buying, and tell them that you're looking to redevelop, and they may offset your state taxes, or they may work with you on some tax deferred or tax free opportunities for redeveloping that area. Really could be at the state level, not at the federal level. At the federal level, it's a lot harder to be able to get those designations done, especially in opportunity zones. But on a state level, you can go in and work to negotiate those things. So especially if it's right by an opportunity zone, and if you can get the municipality to work on your behalf, it's worth the conversation. So go and talk to your local, to the local municipality, the county or the city that you're looking at buying that property in, and then take it up to a state level to talk to one of the state officials that can help grant that for you. And you'll probably have to go through some civil hearings where you go in and present that to the city development planners, and you have the board of trustees go in and they review it, and they either say yay, nay, or whatever it is. But you have to present a good case, right? So you sit back in front of the board of trustees, and they're sitting back reviewing this for tax benefits. What are you going to give back? Are you creating? When are you going to renovate? How much are you putting in? What's it going to look like? What's it going to do for the city, the municipality? Are you bringing jobs? Are they going to make the money back from taxes from employees? Are you going to bring in, what type of businesses are you bringing in? Do you have stuff pre-leased? Do you have, so those are questions that they will ask you, because they just won't give you stuff tax-free unless you have a business plan. And so with that business plan, you need to be able to present to that municipality, the board of trustees, what you're doing. and how it's going to benefit, because it has to be a win-win situation, right? We live in a world where it's not just a take. You got to give and take. And so anytime you're developing and redeveloping real estate, one of the things you want to give in mind is, what are you giving back to the community in lieu of what you're asking for? I gave a fire station. I gave the land for a fire. I didn't give a fire station. I take that back. I gave the land for free for the municipality to build a fire station in one of my subdivisions. I was having a really tough time. One of the big issues there was water. And the second issue was for property insurance, because there wasn't a fire station close enough. And so after about 9 months to a year of negotiations, I finally said, well, look, what if we granted you guys 2 acres to build a fire station here? We'll give you the land for free as part of the deal. And we'll designate that as part of the development, and we'll take care of infrastructure. We'll take care of the grading and drainage, all the hydrology, and hence, lo and behold, they took the 2 acres. That made the deal go through. That right there made the deal go through. I didn't have to pay for the fire station. They did it. They raised money through bonds or through grants or whatever they're doing, and they took advantage of it. Oh, which, John, that's another way, grants. My brother-in-law deals a lot with this stuff, and I'll tell you guys that if it's near an opportunity zone, but maybe not in an opportunity zone, there's a lot of federal money available to help rebuild some of these areas. And that's one thing you can do on a federal level, is ask for a grant. And the grant, you'll have to have a grant writer help you, or you can do the grant writing yourself if you understand how to apply and facilitate grants and grant writing. And you can apply. There's a lot of money out there. There's a lot of federal money out there that you can utilize for these developments. And so if it's real close to an opportunity zone, you can take advantage of it. And all you have to do is apply for the grants. And there's multiple ones in there, minority business owners, women-owned businesses, you women investors out there, tons of opportunity for you guys. A lot of you Asian, Hispanic, there's a lot of opportunity out there. Everybody's a minority, it's like they say, white Americans, like, okay, I'm German, I'm Scottish, whatever it is, everybody's a minority. So I laugh at that stuff, because I was an 8A contractor, which means you were a minority contractor years and years and years ago, and I get a 10% variance on the lowest bid. I could be 10% higher than the lowest bid, and I get the federal contracts. And that's how we actually started doing government work and federal work with our construction company over 20 plus years ago, because we were an 8A certified contractor, and it gave us the relationships and the ability to get in. And a lot of that is through grant writing, getting grants, finding out, doing a little bit of legwork and finding out a little bit of information. But there's a lot of money out there, and there's a lot of tax benefits out there. And for those of you guys who aren't taking advantage of them, who do own real estate, it's something that you need to take advantage of, and you need to be really good at record keeping. One of the biggest things that you need to be when you're in real estate is you need to be a good record keeper. Hands down, because the better the record keeper you are, and the better of an accountant or CPA that you find to help you with these tax laws, the better off you're going to do long-term, offsetting or diminishing your deferring your taxes or diminishing your taxes in some instances. And so people get mad at people like Trump, and it doesn't matter if you love him or hate him. These are tax laws that benefit the wealthy, the smart, the business owners, people that are in real estate. So when people get frustrated by it, just because they haven't learned the game. But let me ask you guys all a question. Whether you love Trump or hate him, who cares? Wouldn't you love to take advantage of the same tax benefits that he does, being a real estate guru? I mean, I do, and I will, and I love it. And so anyways, those are topics those are tax benefits that the wealthy exercise and take advantage of, and I recommend you do too. But ladies and gentlemen, it's Wednesday afternoon. It's Real Talk on Real Estate, and today we were able to get in here, and we were able to talk about the 5 tax advantages of real estate investing. Take advantage. If you love if you love this content and you want to see more content just like this, give us a big fat thumbs up. Give us a little bit of love right now. Go down below, hit that thumbs up button, and give us some love. If you haven't subscribed to our YouTube channel, do it right now. Click and subscribe to that YouTube channel for more content just like this in real estate developing, investing in real estate. But give us a little love. Give us a thumbs up. For those of you guys right now, I want to see that thumbs up button go and increase in numbers, and subscribe to that YouTube channel. If you are watching this on replay right now in the chat, type replay. Ladies and gentlemen, go out and make it a great day. God bless, and go out and compound your success.
Daniel.
It's a real dry subject.